This is our Forex blog for April 9th, 2013, and like we do most days, we show our currency indexes. In the past, for the previous 6 years when we did our blog videos, we would show the currency meter, which basically shows each currency's statistical strength or weakness, and you would basically look for intensities to the downside for continuation trades. Underneath that, we have the daily, weekly, monthly trend. What we're doing now is we're focusing on our currency indexes. Instead of just statistically comparing each currency to every other one, what we're doing is comparing them visually as a chart. And it lets you see patterns such as double bottoms, it lets you see trend line breaks, it lets you see when a currency is breaking out of yesterday's high for that currency, which is an event that tends to continue up. For example, the dollar, when it came down to yesterday's low, it acted as support. Once it finally broke down, you can see for the next 2 hours it continued. There's so many predictable patterns by using our currency indexes. And when you make them all the same color up here, orange, or any other one, and you click on this tool right here, Demo Trade, when I scroll back, we'll be able to have them all scroll back. And so basically we can look at these currencies pretty much starting at 3, and we can see the types of trades that we'd be taking. First of all, let's go over how to use this. This is a dollar index, the yen index, the euro index, the pound index. Basically what you're looking for is a currency to be trending up, to be above the hourly moving average, which is in gray right here, and ideally to be above the point of control, which is what the average price is for all the dollar pairs yesterday. Underneath that, it tends to go down. Underneath that, the hourly moving average, it also tends to go down. When a currency is above the point of control and the hourly moving average, it tends to go up. Currencies that break the previous day's high, which you can clearly see, this is the index's high yesterday, shows a dotted green line right here. Those are some of the strongest ones. Currencies underneath the previous day's low are some of the weakest ones. Basically, in a nutshell, we want to buy the strongest ones versus the weakest, and if the one on top is the weakest, we want to sell that currency versus the strongest one. Now, another thing I've put in here is not only the daily point of control, but we have the weekly point of control, which is much thicker and in orange. And I also show if during the previous week the average price of, in this case, the Australian, went up or down. Last week, the Australian went down 31 pips based on the index. That's a pretty significant amount. And so that tells you that last week was a down week. Yesterday, the point of control went up a measly 5 pips. So basically what it's telling you is yesterday was a slightly up day, last week was a down week, and it's underneath the hourly. If it breaks down underneath this area here, it's likely to work down to here. If it breaks underneath there, it's going to probably go down to yesterday's low. And basically you continue to trade these patterns until things like that happen. So let's scroll through here. The weakest one is the Swiss because it's underneath the previous day's low. The daily trend is down. The weekly trend's just barely up. This one's in a choppy pattern. Clearly the longer term trend is more down than up. So ideally we'd want to see the CAD break down underneath the low right here and we'd sell it. The pound has a longer term trend that's down, but you can see it broke out. Anytime you get a breakout of a multi-hour rectangle pattern, it's a pretty high probability trade. The yen, even though the longer term trend is down, it made a strong move up today. If you were going to look for a counter trend trade, because the longer term trend's down, draw your trend line on there, and around 3:30 look to sell it because it broke the trend line. Also yesterday, it had a tremendously huge down day in the yen, so it's really likely to stall and reverse at the upper containment band. This is one of the higher probability trades right here at 3:30. Ideally, we want to find a currency above the hourly, above its point of control. Most of these are going sideways right now. The euro would be a good one because the longer term trend's up, but it's underneath its hourly moving average. So I would say at 3:30, actually at 3:30, you can see the euro kind of broke through its trend line pretty much close to that. The euro yen at 3:30 is an excellent one to be selling. I'm sorry, buying. Strong euro, weak yen, or likely to be weak yen. Let's take a look at the euro yen at 3:30. And this is how you use this to predict likely trend direction. First of all, This is down near our lower containment band. Most of the time the white 2.0 band reverses, causes price to reverse. And with our perfect oscillator, when it hits the minus 80 level, it tends to go up. When it hits the plus 80 level, it tends to go down. Notice here, 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 and notice on the price chart, the bottom, the high. I mean, this one here did kind of drift up slowly, maybe about 15 pips over the next hour. And then all this is telling you it's up or down too much. It doesn't mean it's going to go up 30 pips or down 50 pips. All it means is it's likely to stop. And you can kind of see this one here failed. It was down too much, but the trend continued. It was down too much again here. You got a little bit of a bounce, and when it hit the lower band, it's at an extreme move up. This trend was down, and it had a pullback right here. Notice an extreme, and again right here, that was pretty much the end of the move. It kind of went up a little bit, down, and then up again. And this again was very close to the minus 80 level. So, and also keep in mind, plus 80 level just a few minutes ago. That stopped the up move. So this perfect oscillator is just such an easy way to trade. And you can see, you know, it worked here, 1, 2, 3, mildly here. Let's count how many there are. 1, 2, 3, 4, 5, 6, 7. There's another one here at 8, 9, 10, 11. How many of those worked? 1, 2, 3. Barely worked, but it did work. So that's 4. This one failed. 5, 6, 7, 8, 9. So 9 out of 11 of them worked when they hit these extremes. That's pretty good odds. And again, that's why I call it the perfect oscillator, because it's based on each currency's volatility for different times of the day. It doesn't use a look-back period, which I think is complete bull and, you know, causes all kinds of false patterns to show up. Anyway, getting back to that 330, we knew that the euro's longer-term trend was up. It's likely to reverse. And you can see right here at 330, we got an extreme area, and you got a nice, huge 75 pip bounce off of that. Now, what I would do is when I see charts set up for trades like that, I will go to either a range chart or a tick chart. So let's take a look at the euro yen. And the reason you want to use a chart other than a 5-minute is to have smaller risk. So if you're wrong, you lose less. And when you're right, you typically make the same amount. So anytime you can do anything that cuts the size of your losses while not cutting the size of your wins is obviously a smart thing to do. So, you know, anything that is a smart thing to do, you should do it. 330, you can see on a tick chart, made a little double bottom right here. You're always looking for the previous swing highs for it to break above, but you can see it found support here. When it goes over that bar's high, you can go long, put your stop underneath the low here, and then you're looking at this as, you know, resistance. If it goes above that area, it's likely to continue up. And usually when you do counter trend trades, this is where the first point where it went sideways, you're going to get at least a 2-wave move. So you're in right here, goes up, sideways, and you're looking to get out at the first or second fib target. I would have probably been out of the whole trade here at 14, but in this trade here at 50. So that's 64 pip profit while risking maybe about 7 or 8 pips. That's smart. Another thing you can do other than use a tick chart is use a range chart. Let's say 5 pips per bar. Instead of time, instead of ticks, this is based on purely movement. Every bar let's get rid of all these lines on here. What's nice about this is you can also see the double bottom, and there's certain patterns that tend to be reversals. Double bottoms, obviously very high probability, and anytime you have a 3 to 5+ bar movement down, there's down, 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 1, 2, 3, 4 bars down, 1 green bar up. When it goes 1 pip above that bar's high, you're in, and you just simply put your stop right underneath the low. And you can also see just, you know, beautiful patterns on range charts. It's my preferred trading vehicle. Every once in a while, I look at a tick chart too, just to be safe. So you're in that trade here. It goes up. You know, obviously you move your stop up, move your stop up. Kind of visualize the wedge pattern on here, and you know, put your stop mentally underneath that. And then when it kind of goes up, and you can clearly see it's kind of running out of steam, you might put your stop underneath the lows here. and then get out here at 129.20. So using the range chart, you probably made another 6 pips on it. Again, it's one of my favorite charts for that reason. So let's kind of scroll through here. Anytime you see currencies in very tight rectangle patterns, breakouts tend to work. You know, ideally we want to trade in the direction of the longer term trend, which is on the bottom. So if the New Zealand popped out above yesterday's high, that would be a good thing. You also want to buy pullbacks in strong trend. So we're going to scroll through here. Now, the pound, the longer term trend is down. Yesterday was an up day. It went up 64 pips yesterday, which means, you know, it's more likely to find support at the previous day's low, which it did. Having seen that, you know, buying that breakout there at 4 was a very high probability in the pound. And at 4 o'clock, one of the weakest ones is the Swiss, because it's underneath the previous day's low. Let's take a look at buying the pound Swiss at 4. So here's 4 o'clock. This one, you know, had been trending up for a while. It really is a nice little rectangle pattern. And anytime you, I don't want to ever or very rarely buy above the 2.0 band. The 1.5 band's okay. This is a potential profit target though, so the only downside of this trade is you're, you know, you have a pretty high chance of only making 15 pips on this, but your stop is very close. As long as you're going to make more than you're risking, it's okay. And again, you want to use a range chart or a tick chart to get in this and to minimize your risk. So let's go to the pound Swiss, and we're looking at this at 4 o'clock. On this chart, you might actually be able to get this on a pullback. So here's 4 o'clock actually. Instead of buying the high breakout, you have a 3-bar pullback, like I just said before. When it goes a pip above that green bar, you get in. Your stop's right underneath here. You're not even risking 10 pips, and you got into the trade instead of at 96. You got into it maybe around 87. So you got almost 10 pips less risk. You're in the trade 10 pips earlier, and you also have your fib target of this last wave. Good place to get out of half your trade, and I would have probably got out of the second half somewhere down here. And if it's strong enough at that time, you can also buy this pullback. Now, it's already up and hit the 1.382 most of the time, probably 80% of the time, trends stop at this. So this is your profit target, which you can see is what it hit. You're in that trade at 4,300. You made 30 pips on that one. I would just get out of the whole trade here and not scale out. But you can see you got a nice 10, 20, 30 pips on the first and 30 pips on the second trade. Two trades with 60 pips by using the indexes. Here the Australian broke out after being in a range for quite a while. Because the previous day's high is right above that, 430, you're kind of waiting for the high to get broken. You're in this trade right here. What's one of the weakest ones? Well, it's the Swiss. The Australian Swiss, probably going to make 20 to 50 pips on it. When you're in one of the stronger ones versus the weak, that's what typically happens. So what is this time right here? 430. 430 is when it pretty much happened. You can see 430. If you got into this trade right here when it broke out, it went from, let's just round up, 70 all the way up to 90. So 20 pip move. And again, with a tick chart or a range chart, you could have got in with less risk. Once these currencies make moves, typically you're going to get a pullback trade. A lot of times currencies will retest. Once a support area is broken, like the previous day's low, it will tend to retest it. If it can't get above it, early at 4 o'clock is a very high probability place to be selling. At 4 o'clock, what was one of the stronger ones? Well, the only downside of the yen is the longer term trend's down, but you did have a very strong move up and then a pullback right to 4 o'clock. It's likely to try to work its way back up. Whether it continues up to the highs or higher, you never know. Also at 4, one of the better trades was the breakout in the pound. So we already showed the pound Swiss, so I won't go over that one again. Let's scroll forward a little bit longer. Trying to show and simulate live trading here. And you can see that Australian just continued up. At 4 also, the dollar longer term trends down. The point of control is right here near the middle of the range. Couldn't get above it. So anytime the point of control can't get broken, it's a very key thing to be watching for. So when it finally breaks out of that little range right there, around 420, very high probability one to be selling the dollar. The Australian's going up and the pound's going up. The dollar after 4 very likely to go down. Let's take a look at this one. We'll start with the pound dollar, 4 o'clock. And you can see this one at 4 o'clock pretty much broke from underneath the hourly moving average to above it. So you have very good potential profit all the way up to the upper containment band. It's 10, 20, 30, 40 plus pips away, and your risk would be right underneath the swing low. This is what you're risking. This is what your potential profit is. It doesn't always go to that area, but you have to use some kind of guideline in estimating what your risk versus your reward is. And anytime you have the opportunity and a good chance of making 5 times more or 4 times more than your risk, you got to take the trade. It's a no-brainer. Again, let's take a look at this on a range chart. Pound dollar. Because if you miss that first trade at 4, usually on a range chart you're going to find some other opportunities to get in this. So here's the trade at 4. You also kind of have a little wedge pattern breakout there as well. And I don't have any indicators on this chart, but if you missed that trade at 4, you might have got back in that trade right here when it had a 3-bar pullback, and guess what? You got stopped out with a loss. Hey, that's all right. Losses are a part of the game. This is really the first one that we'd had using our method today. So you have maybe 6 to 8 pip loss. You have another 3-bar pullback, 1 green bar up. You get long right here. You put your stop here, and it's pretty much just going up, down, up, down. That's always scares me when I see that pattern, because usually that means the trend's going to fail. So a lot of times I'll move my stop up somewhere, or I'm watching it like a hawk. As long as the pound index is going up and the dollar index is going down, I will stay with the trade. You can draw your fibs from here. You can also draw your fibs on this last wave right here, which probably is where the market stalled. I'm going to do that right now, just so you can get a feel. The market went sideways from there to there, went right to the 1.382. So I always kind of draw fibs on both areas. If it stalls at 1 and gives a reversal pattern, you just got to get out. But nonetheless, let's say you lost 7 or 8 pips, you got back in it at 90, you got out here at we'll round up a pip at 20. You made 30 pips and you lost no more than 10, so you netted 20 on 2 trades. So the other one that we were going to watch at that time was the Australian versus the dollar. Strong Australian, weak dollar. Obviously at 4 o'clock it's going to go up. And this is a really good trade because the hourly moving average oftentimes acts as support. At 3 o'clock it came down, acted as support, so buyers were there. It also has the beautiful aspect of having a nice little rectangle pattern, and I'm going to just kind of wait for it to go above that rectangle pattern's high, pretty much right here. Stops. I'm going to put mine right here because I like to have the smallest one possible, and this is a potential profit target, as is this. And to keep things simple, I don't have all these other tools on the chart, but you can use daily, weekly, monthly pivots as profit targets, daily and weekly value areas as well, and so forth. But anytime you have a good possibility of this much profit while risking this little, you got to pull the trigger. It's a no-brainer. If all you do is focus on high probability trades using our tools, which you can't get anywhere else, and take trades that are likely to give you 2 times, 3 times, 4 times, sometimes 5 times more profit, so be it. Now, anytime you see the perfect oscillator go above 80, it can reverse at any time. So I'm kind of just putting my stop underneath each bar's low as this thing goes up, and sometimes they just keep going. So I would have got out of the whole thing right here at the upper band. Most times, when the perfect oscillator shows plus 80, you're going to get some kind of reversal. And when it doesn't, typically if you want to do counter trend, if you miss the trade, when you get a plus 80 signal above our upper 2.0 band, rarely does it go above the fib target. So I will oftentimes kind of scale into a trade up here at these super high extremes, and then as you can see it pulled back. I'm going to get out of there with maybe 15 pip counter trend move. That's another thing that you can do. You can, let's scroll these forward, you can use trend lines on these indexes. to spot reversals. The pound, was trending up. Notice at 6 o'clock, it found resistance right here at the point of control. The longer term trend's down. Trend line break. With our old currency indexes, you couldn't use trend line breaks. You can't see a currency really is not going down anymore. Here's a kind of a trend line break off the highs when it wasn't able to make new lows. What a high probability Swiss buy at 10:30 or 10:45. At 10:45, we want to find the weakest one, or likely to be weakest one, to buy or sell the Swiss against. So what's that? The Australian's going up at 10:30. The New Zealand's going up at 10:30. This one was not able to get above resistance all day, and it made a new low from before. I definitely like trading the Swiss against the CAD. So we're going to sell the CAD Swiss at 10:45, coming up to 11. So guess what? Seeing that trend line on the Swiss index at around 10:45, which would have been somewhere around here, you have a beautiful breakout to the downside about 10 to 15 minutes later. And this thing fell 10, 20, 30, 40 plus pips. And your stop would have been right here. Now you don't know what your profit target is on this. It could find support here at the hourly and then bounce up. But if it goes through there, the lower containment band's great profit target. Again, another amazing trade where you're risking a super tiny amount and your profit was 5 to 6 times, maybe even 7 times, not 7 times, 3.5 to 5 times bigger than this. Amazing. And that's really all you got to focus on. You would go short the second it broke through the trend line right there. Whoops, I meant to trying to use these arrows here.